Hey, what's up, apes? Hope everyone's having a great weekend. We're going to look at render today, and I'm just going to try to size up what the next week or two could look like. Obviously, this one's been outperforming all other alts, and if you look at the BTC render pair, it's obviously doing really well. So in this uptrend, we're looking at one major key level right here on the daily. You could see it's been very reactive. 1, 2, 3, and then here's your break of structure, back test. This was an SR flip and then down until you hit the nadir just over here. It left behind on the weekly a pretty strong weekly imbalance. So if you just kind of look here, this candle right here, and this one was as well, but you could see we recovered it over there. So that's the weekly. Now on the daily, one of the other things you'll notice here is we had equal highs. So equal highs tend to be a draw on liquidity once the momentum is going in the same direction. It's an area that you like to see resolved before a potential reversal. And that's typically where market maker or any of the big wallets that need to, ladder into a position. Otherwise, if they go all in at once, they would experience slippage, or they would nuke or just turbo send the market. So they tend to keep it in a range where they just start building the position. So this is an area where you could expect, if they were going to pull it back in premium, this would be an area where a big wallet or institutional buyer would be offloading a position in premium. So here you have one high, two high, even this one third and fourth. So you basically have like 3 or 4 relatively equal highs. And you could see on this candle, it just ripped through into that weekly imbalance and rejected. Now that high's been taken, one of the big draws on liquidity to the upside has been resolved. So I'm going to get this off the screen. There it is. Okay. So now we basically hit the midpoint in the weekly imbalance here. So this is kind of like a mean threshold. If you look at your range of that imbalance from here to here, that's your EQ or your midpoint. Some call it the mean threshold. A lot of the time what you'll get is once a draw on liquidity has been resolved and the move to the upside is about to reverse, you like to see at least half or that mean threshold get mitigated before the move down. So that doesn't mean that it's going to reverse here. It just means that this is an area of interest where you would start hunting for shorts, or you would look to close along potentially. This could easily pull back and then do a third drive up, which is actually where I think this is going. What it did on that move up is it left behind a few major daily imbalances. So you have one right here on this candle. You have another one right here. And you can see the more recent one right here. So I know Thor and Fight and Bando, they talk about this institutional order flow drill where basically there's stacked FVGs in the same area before the move up. So what I'm thinking is, at this point, you could see this area is being rejected. If you flip the chart, you would look at this as, oh, okay, this is decelerating. Maybe it's time to start considering long. So the same thing here. It's decelerating the move to the upside. So you'd be considering maybe an area for a short. If it does, then what you're looking at is basically a pullback into that first imbalance over here, maybe at the mean threshold, or it clears the whole thing, and then continue the move up for a third drive, kind of like that. And that would totally mitigate the weekly imbalance right there. So that's an idea that I'm kicking around. Now if we go into a lower time frame, I've been tracking this ascending wedge where basically you have higher highs and you have higher lows building within the wedge. And these tend to break to the downside. I think it's 70% probability in an uptrend when you start forming something like this and you show a sign of weakness, they break down 70% of the time. So then you would expect some corrective retracement coming off this. So the other way to look at this is you have your first established high here in a 1 hour order block, I believe it was, or a 2 hour, can't remember, but it was a low time frame order block. So that was an area of interest that I was watching. Then you have this taking liquidity here, and then you have a nice impulse candle here deviating above what I call a shelf. So if you just extend this as a reactive line across, you could see when it falls back in to the range, it rejects it again on the backside over here. And that's why I've highlighted these 3 points over here, because what it's starting to look like is a deviation over there. And if that's the case, then you're looking for, was there an order block in this general area under or around the shelf that you could, that's a weekly 2 hour, that you might consider would be the area where the order flow reversed. And you can see here, after the deviation back into the range where you have the shelf, there's one up candle before a liquidity clearing wick, and then a big energetic push down. That was a 5% push down on that candle. So that's what validates this as an order block. Now, if you carry it forward over here, you could see the next interaction with that order block. It basically filled right to the top. So up till here, it wasn't, if you look at it just like this, up till here it was an untested order block, right? So it was initiated here, energetic push down, and then you're looking for the retest of the order block. And you could see once it retested, reject, and then it rejected again here. So it's pretty much validating this as a bearish order block. And what you're looking for now is maybe one last push up, clear liquidity here for the front side shorters, and then a move down. So that's what I'm actually waiting for that. Especially with render, I noticed that it likes to trap front side shorters that are, they come in early and commit their liquidity here, and maybe one more time. And then the real move happens on that third drive into the order block. And then that's where basically all the front side guys get knocked out of the position, and the real move down happens, which I think is going to be, 14-15% into that daily imbalance that we identified over here. So right in there, around 210, 211, kind of makes sense to me for a pullback. The other way to look at it, if you're looking at a measured move, you're basically taking the top of the range where it started forming to the bottom, right there. And then you're taking that and applying it to the breakdown area, which is right over there. And that would take you to the mean threshold of that daily imbalance. So for me, this kind of has some confluence based on the ascending wedge measured target and the fact that there is a draw on liquidity to the downside. This would also give time for the oscillators to cool off. You'll notice on the daily, that we have Class A bearish divergence, where you've made a higher high on the daily on price, and we're only using the candle closes, so technically at this moment it's right up to there. Wicks don't count for this. And then on the RSI, you can see we made a lower high, substantially lower high. And right now it looks like we're curling over to confirm it in the bullish control zone. So if that plays out on the daily, that usually tends to create a larger corrective retracement, which is why I'm thinking that this could go into a 14% drawdown from here. But I'm waiting for that one final scam pop to fade. As soon as it comes into that shelf again, I'm going to look for weakness or a really strong wick that clears all the front side, and then I'm going to jump in with a market short. So what I'm thinking, the last idea that I have here really is we have a bit of a market maker sell model or buy model happening right now. So if you go into the 6 hour, I'm doing this just to compress the data on the chart into, you know, something we could view on one pane or one screen. But the idea is these models, they begin with a accumulation. So you can see it's in an uptrend. It had a really nice drawdown. That was like 25% drawdown. And then you formed a range. So this is like a consolidative accumulation range. And then you get your first drive up. That impulse basically pulled back, formed a range high, range low, and then you expand it again. So this is your first area that they've distributed in. And then here's your second push up, which we're in right now. I'm thinking that it's going to at least go into clear the weekly imbalance, because right now we only hit the EQ, but I think it could push up one more. And I don't think it's going to take out this liquidity. The way these normally work is you're going to get a push down and engineer more liquidity by giving retail confidence that this is a protected low. So they're going to basically put their stops below here, and then they're going to get a free ride into the climax within the buy model, which should be at the top in a very clear high time frame point of interest where the draw on liquidity would be. So you can see they did it here too. Oh, hold on one sec. Why is it doing that? One sec. All right, so you could see here this low is lower than this one. So they basically allowed retail to get into a long here. And what that is, it's basically, you know, committing or engineering liquidity here on the front end so they could take it back on the back end over here within this buy model, sell model. Sorry, I don't know why I keep saying buy model, but this is going to be a sell model. So anyway, there's a lot of liquidity here, some here, 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 and then likely there's going to be some more built up here, and you'll go into a distribution at the top. What I'm seeing is equal highs at the top. So if you zoom out, you basically have these open wicks, meaning from this original wick, after this liquidity clearing wick, before the real push down, you could see there's a wick here that's higher than this one, which is higher than this one, higher than this one, this one. So these are basically forming what I call a liquidity arc. So basically, if you use a magnet and you attach it from here to here, you get the picture. You basically have all this open liquidity that hasn't been taken out yet, which is essentially forming the equal highs over here. And this is where I could see the point of interest being between that equal highs and the key level. So the key level, if you look at it, when you zoom out, in a line chart, it's very easy to see. It's the most reactive candle close level that you could see they honored over here. And then more or less, that's where the SR flip happened before push down. So this right here is going to be a key level that I think lines up beautifully with the top of this sell model. So this will be your distributive top. It should take a little longer, meaning it's going to, you know, to offload that major accumulation here, you're going to need an equivalent amount of time to do it here, because if whoever cornered the flow or the market maker, if they just start dumping recklessly in market selling, that's obviously going to crash the market and the price. So that's not what they want to do, because for the, you know, the longevity of an asset, you can't crash the price. It would discourage all market participants, and then no one's going to try to bid on this when it does come back into value. So that's why these distributive tops are typically selling in premium, selling into strength, and taking an equivalent amount of time to distribute as the accumulation before it ran up. So when that happens, what you're looking for on the back end is any liquidity built up here is going to be getting zapped over here. And what normally happens is they'll fall short of it right here, just again lulling more liquidity into the market before the next distributive move here happens. So then, you know, retail is going to be baited into thinking this right here in this range is going to be a demand zone, or an area where the price should not break below. So they'll have confidence, they'll long here, or they'll buy spot here and then put their stops below this level here. And that again is going to get nuked on this next move. And then you're just doing it progressively one level at a time. So any liquidity here, they're going to get taken out same way they did here until the final drawn liquidity is met, which is probably going to be in this range, and it could be down here as well. So on high time frame, you're just looking for where that drawn liquidity could climax. My guess is it's around the $1 to $1.10 mark, somewhere over here. So again, in between this is on a 6-hour time frame, but you know, whether you're on daily or 1 hour, price is fractal, and the idea is you're going to get impulse wave, corrective wave, and then you're going to keep doing it as long as you're bullish until you hit your high time frame point of interest, which is going to be likely that 3 equal highs over there into the key level. So that's where I'm going to, if I do buy or take a long anywhere in value for that last move and that blow off over here, it's not going to be a blow off, it'll be distributive, but this is an area where I'm going to take a max short if we do get to that level. And this is an area where I think I would be comfortable longing if we do get that level as well. Again, there's a lot of liquidity even below that, so that might not be the Pico bottom. You basically have this range right here. So I think if this gets zapped, here you could roll the dice and punt along, but I'd still want this to get taken. And then worst case, if it doesn't hold and we're in a big substantial drawdown this level over here, you could just buy and hold. Render is basically like ecosystem play. So for Web3, they're going to need this online storage, on-chain storage, and Render is going to be here with a lot of the big companies. So you could just buy and hold. If it goes down to like 38, 20 cents, you're pretty safe. At that point, the market cap is going to be so low that, you know, it'll probably be under 100 million, and you could just sit on that position, because as soon as some, you know, big wallets come back in, the price is going to 3x again, or 4 or 5x, whatever it is. But yeah, that's Render. Hopefully you guys see what I'm seeing, and if you have any questions, just let me know. I'm here.